A. Manage optimal cash positioning through short-term investing and borrowing activities. Effective cash positioning is a fundamental responsibility of Treasury professionals because organizations must maintain sufficient liquidity to meet operational obligations while minimizing idle cash balances. Treasury management focuses on balancing liquidity, safety, and yield through disciplined short-term investment and borrowing decisions. Professionals continuously monitor daily cash inflows and outflows to determine surplus or deficit positions across bank accounts, subsidiaries, and business units. Accurate cash visibility enables organizations to optimize working capital, reduce unnecessary borrowing costs, and maximize returns on temporary excess funds. Treasury teams rely on cash forecasting, bank reporting systems, and liquidity analytics to support informed decisions regarding investment timing, funding requirements, and operational liquidity management. Short-term investing activities are designed to preserve principal, maintain liquidity, and generate modest returns on temporary excess cash. Treasury professionals commonly evaluate money market instruments such as treasury bills, commercial paper, certificates of deposit, repurchase agreements, and money market mutual funds. Investment decisions depend on risk tolerance, investment policies, liquidity requirements, credit quality, and market conditions. Treasurers must understand maturity structures, interest rate exposure, settlement procedures, and counterparty risk when selecting investment vehicles. Diversification across instruments and financial institutions helps reduce concentration risk and protect corporate liquidity. Effective investment management also requires compliance with internal policies, regulatory requirements, and board-approved guidelines governing acceptable investments and exposure limits. Short-term borrowing activities support organizations when operating cash flows are temporarily insufficient to fund working capital needs or unexpected obligations. Treasury professionals evaluate borrowing alternatives including lines of credit, revolving credit agreements, commercial paper issuance, bank loans, and overdraft facilities. The objective is to secure funding at the lowest possible cost while maintaining financial flexibility and minimizing refinancing risk. Borrowing decisions require analysis of interest rates, credit spreads, loan covenants, collateral requirements, and repayment schedules. Treasury teams also assess the impact of borrowing on leverage, liquidity ratios, and overall capital structure. Maintaining strong banking relationships improves access to credit markets and strengthens the organization's ability to manage liquidity disruptions effectively. Cash positioning requires continuous coordination between investing and borrowing activities to avoid inefficient liquidity management practices. Treasury professionals seek to minimize idle balances while preventing cash shortages that could disrupt operations or damage supplier and lender relationships. Centralized treasury structures, cash concentration systems, and notional pooling arrangements improve visibility and allow organizations to use available cash more efficiently across multiple accounts and jurisdictions. Daily liquidity analysis supports decisions regarding debt repayment, investment placement, intercompany funding, and account transfers. Treasury management systems and enterprise resource planning platforms enhance real-time monitoring and reporting capabilities. Strong internal controls, segregation of duties, and reconciliation procedures are essential to ensure transaction accuracy, fraud prevention, and operational reliability. From a CTP examination perspective, candidates must understand both conceptual principles and practical applications related to short-term liquidity management. Exam questions frequently test the ability to evaluate investment alternatives, calculate borrowing costs, analyze money market instruments, and determine optimal funding strategies under changing market conditions. Candidates should be familiar with key treasury concepts including liquidity risk, yield calculations, cash conversion cycles, working capital management, and interest rate impacts on financing decisions. Strong analytical skills are necessary to compare short-term financing sources and investment opportunities while balancing liquidity, safety, and profitability objectives. Mastery of these concepts enables treasury professionals to support organizational stability, financial efficiency, and long-term strategic objectives.